So what's this paper about? I'm really going to show you three sets of facts. The first set of facts is looking across countries and trying to understand the behavior of very long-term yields on government bonds and swap rates. Basically, the thing that we're going to show you is that in countries where there are very large private pension systems, and the private pension systems typically buy very long-dated assets, and we'll show you some evidence of that, although our evidence there isn't the best evidence. We will show you that in those markets, the very long-dated yields, meaning, say, for example, the 30-year yield, tend to be very low relative to, for example, the 10-year rate. And I'm going to show you some suggestive scatter plots along these lines. That's going to be largely cross-sectional evidence. The magnitudes here are pretty meaningful, so think of this as kind of somewhere between a 20 and a 40 basis point impact on the 10 to 1030 spread. So then I think this raises the question of, anytime you see some kind of cross-country scatter plot along those lines, you'll ask yourself, well, really, what's the kind of is there a causal mechanism here? And that's where this evidence in Denmark and in other countries is going to come into play. And so what I'm going to show you is that to a large extent, this demand for very long-dated government bonds comes from regulatory forces, which is to say that the pension funds in many countries are regulated on their solvency. And then how do you measure the solvency? Well, you have to discount the liabilities, the promised payments to pensioners, for example, or to holders of insurance products, because we'll look at insurance as well. So, for example, if you ask the pension fund to discount using a particular yield curve, that induces demand for the reference rate. You can think of this as evaluating a mutual fund manager relative to, for example, the S&P 500. That sort of induces people to hold things that look like the S&P 500. And so we're going to show you a bunch of evidence. I probably am not going to have time to show you all of the episodes in the paper, and so I'll just concentrate on one or two of them. That when you change that reference rate, when you change that benchmark, it has pretty dramatic impacts on the curve. And so we're not going to be able to show you the direct impact there in terms of show you the pension funds trading, but we'll show you the price impact, which is consistent with the pension funds really leaning to the benchmark. The third set of facts that I'm going to allude to is when you look at all of the episodes where you have this change in benchmark, they have a striking commonality, which is that the episodes themselves are not endogenous. So think about that. Why would anybody ever change the benchmark or the way that you are discounting the liabilities? Well, it's when the regulator, when the government is becoming concerned about the solvency of the pensions, and they're becoming concerned about potential behavior of the pensions in order to comply with regulation. And so you'll see that there's a common feature of all these episodes is that really you'll have yields either falling in advance of the event and then quickly rebounding during the event, or vice versa, depending on the direction that the event is going. So why do we combine this kind of very broad cross-country type evidence with the sort of very narrow event study type evidence? I think for two reasons. One, it helps clarify the mechanism of what's going on, what exactly is driving this pension demand. And second, it kind of gets you a little bit more comfortable that the stuff that I'm going to show you in the very beginning of this talk is really causal. All right, so with all of that preamble, let me just jump into this. Of course, we do understand, oh, I should do this properly here. How do I show this? Of course, we understand that interest rates have a direct impact on the pensions. In fact, it's a most well understood phenomenon that when rates move, they change the net present value of the assets versus the liabilities. Here we're going to be focused on the reverse channel, where of course changes in the behavior of the pension funds are going to be driving the underlying rates. And so it's interesting, I think, for these three reasons that I've emphasized. One, it tells you about the impact of regulation during periods of stress. Of course, it's evidence of intermediary asset pricing and sort of price impact. And then, third, it's adding to a bunch of evidence that's accumulated over the past decade in studies on QE and studies on government bond supply and so on that changes in net supply of assets, and particularly in fixed income assets, are changing their prices. All right. So let me start with the cross-country evidence. So this evidence, largely inspired by my colleague David Sharfstein, who in his AFA address alerted us to all of this data on global pensions. We're using primarily the OECD Public Pension Reserve Fund statistics. We're also using the insurance statistics because in many countries, the retirement systems, they're not exclusively done by pension funds. Insurance companies are also providing some of the retirement assets. Okay, we're going to exclude country years here where the 5-year government CDS spread exceeds 200 basis points. We're not really interested here in trying to understand credit risk in countries. We're trying to sort of take that off the picture. So just think of this as basically excluding, for example, Greece in 2009 and 2010. That's not what we're going to be about. Okay, so first, just a little bit of descriptive evidence here. This is just a picture of pension and insurance assets to GDP. You can see the remarkable range here, and you can see why Denmark is kind of an interesting example. I'm going to talk about Denmark later. Denmark has this enormous pension and insurance sector, well over 200% of GDP. The US, you can see, is kind of in the middle of the pack. They have a pretty large private pension system, but it's not as big as Denmark, the Netherlands, and or Sweden for that matter. Okay, and then of course there are many countries, pay-as-you-go systems like Germany, for example, which have much smaller systems. Okay, yeah, I'm going to skip this. Now, here's another piece of evidence that I think is interesting, and we have, frankly, this is the only thing that we could get our hands on, and people are starting to come out with more statistics on this. This is a picture from an ECB study, which is looking at the holdings of euro area investors, and particularly the maturities of those holdings. And it's a little bit hard to see the picture from a distance, I think, but let me basically tell you what it does. It is looking at here monetary financial institutions, that's the dark blue line, insurance companies and pension funds, other financial institutions, general government, and then at the very end, households. And basically what you're seeing here is on the bottom axis is the maturity of their holdings. And again, if you look at that red dashed line, you can see those are the pensions. And you can see that they tend to hold relatively little in the way of short-dated assets, and a little bit more certainly compared to other institutions in terms of long-dated assets. Here is some similar data. This is bond holdings of Danish investors, and you can see insurance companies and pension funds tend to be very focused on the long end of assets. Now, it's not exactly surprising. Here's some other data. Again, it's a slightly different source. This is from a BIS paper looking at the durations of the liabilities of different pension funds in different countries. And you can see, for example, in the Netherlands, most recent data, the average duration of the liability is 21 years. And so you imagine hedging that liability, you will tend to be buying longer term assets. So you might want to do this irrespective of regulation if you're trying to, for example, reduce the overall funding risk of the pension program. Okay. So first set of analysis that we're going to do is look at some crude proxies for demand and supply. And the nature of the regression I'm going to show you is looking at the measure of demand for long-term government bonds and, for example, long-term swaps is going to be how large is your pension system. You can think of this as an instrument. I'm not going to use the word instrument. It's an instrument in the sense that we don't actually observe the bonds that they hold. And so we're looking just at the overall size of the pension system. And then in terms of supply, we're looking at how big is the overall government debt. Now again, when you're thinking about supply, you can think about it as an instrument. It's not an instrument, but we're looking at the overall government debt. Of course, the government has a choice as to whether to denominate that debt short-term or long-term. So again, the way these regressions are going to work is we're going to be looking at the spread between 30-year and 10-year bonds, and as a function of demand, which is pension assets to GDP, and supply, which is an offset, which is government assets to GDP. You can also net those out, so it turns out, quite conveniently, that they used to enter these regressions with almost exactly the same but opposite signs, or the same in magnitude but opposite signs, and so you can net those and form a sort of a measure of net demand, and I'll show you some regressions along those lines. Okay. Source of the data I've already talked about. We also do this with a bunch of control variables, for example, the 5-year government CDS, and then you might also control here for the 10-2 spread. Now, I think it's kind of a conceptual question as to whether you want to do that control. Of course, we do think that the spread on the 10-2 is probably also influenced by these forces, but generally we're going to be focused on the sort of very long end of the curve. Okay. All right, here's the basic fact here. So we're plotting here, just as a reminder, the 10-30 spread, or the 30-10 spread as a function of here pension and insurance demand net of government debt to GDP. Okay, and you can see this pretty strong correlation here. I'd like to make one extra comment about this picture, which is that Moto Yogo gave a discussion of this paper. I wasn't there, but my co-author presented about a month ago, and he made a really interesting observation that we haven't really grappled with yet, but I'll just raise it here, which is how do you think about the integration of the European markets? And it's interesting because, of course, Germany and the Netherlands, just to give you an example, are very different in terms of the size of their pension systems. And so you might think, well, geez, if they're thinking about it as one general European government bond market, that has one implication, versus if you think of these as very disjoint markets, that has a very different set of implications. And one of the things that he raised, and I don't have time to go through all of that today, is that, of course, that has changed over time. So, for example, our sense of how integrated the European government bond markets are was different, as an example, in 2005 versus 1995 versus, for example, today. And he showed us some evidence that was, I think, pretty interesting for us to pursue. Okay, here are the corresponding regressions. I'm going to skip the regressions and just jump straight to what the magnitudes say. So increasing P&I assets to GDP by about 150 percentage points reduces yield spreads by about 36 basis points. Obviously, that's a big jump, right? So that's sort of moving from one tail of the distribution to the other. And just to highlight, an important offset to this effect is the supply of government debt, which enters with a nearly identical coefficient of the opposite sign. It's interesting to think about other examples here. Of course, the UK has famously shifted the maturity structure of their debt, and I have some work with Dimitri Vayanos along these lines, shifted the maturity structure of their debt very, very long term, recognizing the long-dated liabilities of their pensions. In the UK, it's even more interesting and kind of subtle because the way the pensions are marked is using real yields, and that has put a ton of demand on their real dated instruments. So think of it in their TIPS market as much more distorted than their nominal market. Okay. All right, so we did a bunch of robustness. I think the main one I've already alluded to, which is the question of how to think about collapsing by currency here. So is the euro market fully integrated? So we've combined the euro countries into a single observation weighted by GDP. That gives you the same set of results, but a little bit weaker. You can also do panel regressions using year fixed effects. And then there's some questions as to whether you want to omit the zero lower bound period for various reasons. All right, so I'm going to skip the robustness test and jump to the event studies. So the nature of these event studies, I'm going to explain in very broad terms what these events are about, and then the details of these events are a little bit hard to follow. So I will go through them, but I think it's easier to understand them in very, very general terms. So the basic way to think about this is imagine you're a pension fund, and so you have some promised payments that you're making to pensioners over, say, the next 20 or 30 or 40 years. And you're discounting them. Imagine for a moment that you're discounting them using the Treasury curve. So what does that mean? A 30-year payment, you'd be using the yield on a 30-year Treasury bond to discount that. Now, of course, this might induce you to hold some Treasury bonds. Why? Because as the yield on the Treasuries moves, okay, the value of those liabilities are moving around quite a bit, and that induces some risk in your funding position. So imagine then that you wake up and one day, instead of using the Treasury curve to discount these liabilities, the regulator says, geez, we'd like you to use the Euro curve to discount those 30-year liabilities. Well, geez, you say, well, I'm actually holding the wrong asset now, so actually these Treasuries that I'm holding are super risky, and I'm going to shift my demand towards the Euros. Okay? And that's the nature of all of these episodes that I'm going to look at, which is to show you that is, in fact, it's the regulatory discount curve that is particularly inducing these pensions to buy these long-dated assets. Okay, now you can motivate this using kind of just the simple arithmetic of how pensions do this discounting. Think of the funding position as just the assets minus the discounted liabilities. Now there are different ways that people will essentially implement this equation that I'm showing you, equation 3. Here's 4 of them. So fixed discount rates, current risk market rates, expected return on investments. That's something we've heard a lot about in the United States. And then this thing called life directive. And so imagine when the yield on securities and the discount rate moves, of course the value of the liability changes and the value of the assets can change in the same direction. Actually, let me just jump to this. Oh yeah, sorry. So change, think about what happens when you move the regulatory curve from R to R star. There's, of course, a direct effect on the funding position. When I move from, for example, the Treasury curve to the Euro curve, that's going to change my solvency by some number of percentage points. But the key thing that we're going to look at here is it's going to change the future volatility of your funding position, and that's going to induce this hedging demand to buy the new regulatory asset. Okay. All right, so the testable prediction that we're going to look at is when the market yield on a particular asset is included in the regulatory discount rate, this is going to induce demand for the asset tied to this new reference rate. And conversely, if it's removed, this will reduce demand and thus reduce prices. Okay. By the way, if you look at press coverage of the events that I'm going to look at, they're basically consistent with this. So following a change to the regulatory discount rate in Denmark in 2011, the Danish financial newspaper quoted a pension company executive saying, Danish government bonds are no longer linked to the method for calculating liabilities and therefore become risky to hold. From being gold-plated, they become risky. We've sold everything we could get rid of. Okay? So these are the events that we're going to look at. I'm going to focus on the first one, I think, given that, how much time do I have? A minute? Okay. I'm going to take one more minute. I'm going to take 2. So I'll focus on this one. Here's what happened. So the first line here shows you the discount curve pre-event, okay, which is a somewhat complicated expression and gets even more complicated post-event. Okay? So again, think of this as just moving from a Treasury curve to, say, a Euro curve. Okay? And what we're going to look at is basically we're going to say to the extent that there's a change between these two curves, it's going to induce demand for the change in that instrument. Okay? And what do we expect? We expect the OAS on Danish MBS, it's going to, relative to Danish kroner interest rates to fall. It's because it's inducing demand for Danish kroner interest rates. Okay? And here is the main event picture. And you can see here that the event is not exactly exogenous. You can see that actually the funding position had been moving pretty dramatically of these pensions during that time. And then that red line is showing that there's a huge drop on announcement of the regulatory change. And if you look at, I'm going to just fast forward ahead, you can see many of these events have this similar flavor, which is sort of a change in the formula of how the discount rate is curved. This is another example here. And if you look at here as a similar example of there's sort of a short 2 or 3 week drop in yields, and then a dramatic reversal upon announcement of the new policy. Okay, I'm out of time, so I'm going to just jump to the sort of conclusion. All of these events have that flavor, and so we documented the magnitude of these effects, which it varies event by event, but changing these discount rates impacts the curves on the order of 20 or 30 basis points for each of these events. Okay, I'm going to jump. You can see how many of these events there are. Millions. So just to sum up, again, 3 pieces of evidence. If you look across in the cross-country evidence, yield spread between 30 and 10-year bonds negatively related to the size of the pension and insurance sector. And then 6 event studies. I've only shown you one of them, but the rest of them have a very similar flavor to look at unexpected changes in pension demand. I think what the event studies show you is 2 things. One, that much of this demand for long-dated bonds does come from regulation ultimately. And 2, that the regulator is put in rather a tough position in the sense that they can choose what that discount rate is. And you can see in these examples that when these pensions are under stress, there's pressure for them to change those discount rates.